Hi, Sean Kidney again. I am here to welcome my good friend John Morton, who has a fabulous title. He's counselor to the US Secretary of Treasury, Janet Yellen. We're going to find out a little bit more from John about what that means, but he's also got a few things he's going to tell us about what's going on in the US, what the Treasury is thinking about, and so on. As much as he can tell us, of course, as you know, it's all these things are a little bit tricky. John, welcome to the conference. Thank you so much for being here.
Sean, great to be here. Appreciate the opportunity to speak with you and your friends today and your guests.
Thank you. We've got about close to 3,000 people around the world registering this. I suspect every single one is going to be dialing in now because, of course, the big mystery is what kind of things are we going to see out of the US Treasury and the US government, given the extraordinary, let's be clear about this, commitments the Biden administration has already made, the 50% by 2030 target. And we're well aware that the administration is very focused on 2030 as much as 2050, which is so important, the IPCC tells us. So what's the Treasury role in doing this, given you're specifically supporting US Secretary of Treasury Janet Yellen on this?
Yeah, thanks, Sean. Treasury's got a big role to play, but the important thing is, from a year ago, from even 9 months ago, that we're able to have this conversation and talk about the great things that Treasury is doing and that this administration is doing at the federal level. Obviously, start with the umbrella or the chapeau, which is that this administration is prioritizing climate change, frankly, like none other that has come before it. I served for 7 years under the Obama administration, including in the White House for President Obama, and climate change was a priority, but not nearly as high a priority as it is now. So the good news story here is that we are across all of government really prioritizing action on climate change, domestically, internationally. And my position at Treasury is a new one and an indication of the seriousness with which the Treasury Department is taking this issue. Counselor to the Secretary, I report directly to the Secretary, and my job is to help manage, coordinate, and elevate climate change and Treasury's climate-related actions to the Secretary level to ensure that our actions are commensurate with the scale of the challenge, but also the scale of the economic opportunity that we believe is embedded in the transition to a low carbon and indeed net zero economy. And that's what makes Treasury such an important and exciting place to be working on climate change, because Treasury oversees and has very, very strong equities and authorities in tax policy, in budget policy, in regulatory and oversight issues. And of course, we are the voice and the vote of the US government on the international financial institutions and the multilateral development banks as well. So in the international sphere, we have an outsized impact as well. So across all those issues, tax, budget, regulatory oversight, international relations, international development policy, Treasury is working actively on climate change. And if I could just say, the frame and the overarching objective of Treasury's climate activities, as laid out by the Secretary and as implemented by me and a small group of people at Treasury's Climate Hub, working with the team across the entire department, is to enable and affect the transition to a net zero economy. So as we think through what our climate priorities are, the question is, how are we helping expedite the transition to a 50 to 52% reduction in our emissions by 2030 and a net zero economy by mid-century? And that involves better informing market participants about climate risk, guiding market participants with respect to best practices on setting targets, strategies, and metrics related to climate-aligned investments, incentivizing market participants with respect to tax policy, budget policy, removing of fossil fuel subsidies, things like that, and then helping mobilize finance toward this transition. A lot of the work that we're doing in the international sphere right now is around how do we use public finance to mobilize multiples more of private finance on behalf of our shared climate objectives. So At Treasury, we really see our job as helping to affect and impact financial flows, private market financial flows, in support of a net zero by 2050 target. And that's an exciting place to be, given the tools and the equities that we have internal to the department.
Unbelievably exciting. And can I say, it's like music to our ears. And of course, the steps the Biden administration has taken so far have been fantastic to see a government actually getting serious about what is the fundamental existential challenge facing our economies and our societies going forward. But you said a couple of very interesting things there. You talked about mobilizing capital, which of course is one of the theme of this conference, this organization. Tell us where your thinking is going there about what can be done or how can this happen and what's the role of private investors and markets? How do you see that?
Let's start. Let's start from an observation I had when I came back into government after having been out for a while. I think if the success of previous both U.S. administrations, the Obama administration most notably, and other OECD, G7 countries on climate change and on climate finance 10 years ago was around, let's just say, increases in public budgets toward climate. I think the success of this round of leadership from developed countries has to be judged upon how much did we impact and steer the private financial markets toward clean and greener investment postures. We have known for a long time that public funds are insufficient to address the problem. What we now have are economic tailwinds suggesting that not only does it make good risk adjusted sense not to be investing in brown assets and in dirtier assets, but it makes very good risk adjusted sense to be investing in cleaner and greener assets. And I think that that's the fundamental difference where we are today versus where we were even 5 or 6 years ago, which is today there is a view that the jobs and the innovation of the future lies in sectors and in solutions that are clean and green. We used to state that as a matter of hope and principle. Now we are seeing it play out every day in our economies. And so we have tailwinds. We have economic tailwinds now that are pushing in the right direction, coupled with significant stimulus and fiscal stimulus packages that are coming through our respective governments that we can green and that we can further green. So we're able to provide, I think, strong incentives, not just with billions of dollars, but with tens and in fact hundreds of billions of dollars to help expedite this transition toward a net zero economy. And so again, that's what's exciting. I heard a statistic yesterday. I didn't have time to fact check it in advance of this conversation, but and you may know the number better than I, but somewhere on the order of up to 50% of institutional investors' assets under management right now have some form of net zero commitment related to their management. That's a fundamentally different place from where we were even 2 or 3 years ago. And now, of course, the question of how those are deployed, how effectively they're deployed toward climate-aligned investments, the question of taxonomies and guidelines, all of those things still to be worked out. But at least now we have the commitments being put in place that will drive this transition in a much more expedited fashion.
It is true, things have changed. My friends at Citi told me yesterday that the investment grade debt in Europe, which is labelled ESG, has gone from 6% a couple of years ago to 22% now of the entire corporate debt market in Europe. And of course, what my investor friends at Fidelity and Allianz Bernstein are saying in the US is quickly moving in that direction. So it's exciting. And I think your point about opportunity is such a critical point about this. This is not about burden, is it? This is about making sure that what is going to change is something we can actually capture the opportunities on and make work for private capital, but for our societies, for citizens, for jobs too, which is the transition can be made if we manage it well so it benefits all. So it's really critical. Now, you're actually in the US plunging into a transition right now, which is around infrastructure. You've managed to get, which is a fantastic win on the part of the White House, an infrastructure bill approved. It looks like it's the beginning of the long-awaited, the long-needed boom on infrastructure, and probably green infrastructure, looking at what the bill says and what the administration has been saying. How can we use available public sector tools, just trying to get a bit specific and dirty here, to mobilise private capital to extend this effort? I mean, while we've got $1 trillion bill, we actually know that the investment required is in the multiple trillions going forward. What does that generally look like?
Well, I think as you well know from your area of work over these many years, markets move both incrementally, but also in a bit of a herd mentality. And I do feel like one of the most significant things we can do as a government and as an administration in this administration is to make it very clear that not only that the direction of travel is the one that we've discussed here towards clean, green, and net zero, but there's no going back, right? There's no going back. And when financial markets understand and internalize that recognition, things change extremely rapidly. We've had even in the last 3 days, a series of conversations with extremely large public institutions, public financial institutions, that essentially are asking us to make that point, right? To make the point that there's no going back, because the last shreds of internal resistance within those organizations are still hanging on, but they're one or two decisions and or meetings away from making very, very significant commitments, not just about what they will not own, but about how they'll reorient their future portfolio holdings. And so I do think one of the things that we can't fail to do is continue to restate just how committed we are to this transition. And I think the infrastructure bill is a good sign of that, where we have bipartisan, fledgling, but a consensus on a set of, job creating measures that will propel the economy forward using relatively modest amounts of public money to create financial incentives for the private sector to invest behind those funds. And so our job, again, is to provide that signal, provide that certainty to the extent that we can. And one way we can do that, and this is probably the biggest single news worth of, in climate financial markets over the next several months, at least coming out of the U.S., will be the delivery of a report by the Financial Stability Oversight Council, or FSOC, to the president, as called for through an executive order that he issued in earlier this year. And the FSOC is a council chaired by Secretary Yellen, consisting of the 15 independent regulators in our country. So the Federal Reserve Board, the SEC, the CTFC, et cetera, et cetera. Tellingly, while the Treasury Department is not a regulator, we don't have regulatory authorities, we don't dictate to the independent regulators what to do. We can help set agendas around those for the FSOC meetings. And the first meeting that Secretary Yellen convened in April was around climate change. And so in October, the FSOC report will come forward with a set of recommendations to the president on data disclosure, climate-related financial risk. And that will be a report very, very closely followed, hopefully, by everyone on the line here today, because I think it will indicate a direction of travel forward that is clear and compelling, and hopefully we'll give some strong signals about where the regulatory agencies in the U.S. are heading with respect to climate-related risk and climate data in particular.
So important. This is very exciting news. So listeners, you heard it here, that I'm sure it's not the only place, but this is a really critical part of the development of what's going to happen in the US in the next few months. We've got a lot of investors on this call, John. I'm sure they'll be listening very closely to this question. I want to move to a slightly different topic around data, which is related to infrastructure and related to uncovering. And I talked to you just before about the problem people like Fannie Mae are having of getting access to data to tell them what buildings are green, what infrastructure qualifies, what's the right kind of asset, how do you tell, and so on. And their question is, we've got a lot of data repositories around the US. We need to free those. You mentioned there's an agenda that you're looking at in that area. I'm just curious, and I want to relate it back to the infrastructure agenda.
Yeah, I would say that the most common incoming call that we get and that I get from financial institutions is one that starts with, we applaud the administration's focus on climate change. That's usually a good thing to say to someone that's sitting in the Treasury Department. So we're happy to hear that. Great. Now let's hear what you really need to say. And that is, listen, there's a profusion of standards and data and metrics that are out there. And we would benefit from greater coherence and at a minimum interoperability.
Absolutely.
And even better kind of harmonization.
I'm with them.
What's that?
I'm with them. They're right.
Yeah. I think we all are, and we're at the phase of a market development now where that is needed. And so, frankly, between us and the 3,000 other folks on the call, we are trying to determine how best to engage in that conversation, because we are no surprise to you. We are not going to be in a position to or be able to take a kind of top-down European taxonomy style approach. On the other hand, we do recognize the need for and the barrier that data proliferation and lack of harmonization creates to enabling the types of financial flows that we need to mobilize to get to net zero. So on the pathway to net zero, there is a simplification and an interoperability issue related to data that we have to work toward. And it is an active work stream, not just within Treasury, but within a couple other departments in the US government as well.
Fantastic news. That's going to really cheer up my colleagues at the Future of Sustainable Data Alliance that we're involved with, Refinitiv and Bloomberg and others, because we're examining this question. So we'll wait with bated breath for output in that area. I want to take now go to the other side of the equation now, the bigger picture, which in a way is one of the key issues, the key themes of this conference. The summit saw, the climate summit saw a big advance, really. And I'm going to say full marks to the State Department for the work they did with different countries on bringing strong 2030 commitments to the table. We now have all the major economies committing to variations of a strong 2030 target. We can comment about the detail, but geez, this is a pretty amazing change in the last 2 years from when we had zero commits, not even 2050. We had a couple, I should say, 2050, and now it's all short term. I guess the question now that arises, or the next part of the agenda, which we're going to discuss in the session after this with a few folks, is how could we see a deepening of cooperation between the major economies, given we've got lots of competitive pressures and geopolitical pressures anyway, to drive the world? Because the hypothesis is, look, if we can get collaboration on climate issues between Europe, the US, China, and India, the rest of the world is just going to follow, we think, and Japan in there as well. The rest of the world is just going to follow. But how do we do this, and what are the opportunities? And I'm just curious to see what your thoughts are about what that could look like, given all the other stuff that's going on.
Yeah, well, I think climate has always been a bit of a I don't know, to use the word special. It's been a uniquely both divisive but also unifying issue in some ways. Divisive domestically, certainly within the U.S., but unifying in the international sphere. I mean, I spent when I was at the White House with President Obama, I spent more time in China and India working very constructively, not without our share of kind of public press releases, which might be put out to satisfy domestic constituents from time to time, but very productively on the Paris Agreement, the Montreal Protocol Amendment, the ICAO Civil Aviation Agreement, and so I think that among major economies, there is a I don't want to overstate it, but I think there is a built-in collaborative spirit which guides the climate conversations. Now, that's not to state. That's not to suggest that it's not incredibly difficult negotiating. Secretary Kerry is in China, I think, as we speak right now, or as this is being recorded. Working with China to try to enhance their next NDC. Very difficult conversations. But I do believe, Sean, that the dynamic that existed not so long ago, where climate change was seen as to some extent as zero sum, is increasingly not the case. So, for example, in earlier this year, I think it was in March, in the lead up to the G7, a group of countries came together and agreed to put together something called the Accelerated Coal Transition Program, which is the first of its kind fund managed by the climate investment funds within the World Bank Group to specifically assist countries expediting their transition away from coal. So finance in general in international circles has always been, okay, let's put more money in to do more solar and wind and geothermal. Unless and until we figure out ways to creatively and responsibly expedite the closure of coal assets in high emitting, fast growing, middle income countries around the world, we're not going to get anywhere close to our net zero targets, much less Paris targets. And so we are seeing different types of kind of coalitions come together around new challenges: industrial decarbonization, debt for nature swaps, nature-based solutions investments, adaptation finance. There is more, I would say, innovation and willingness to look at these next hardest nuts to crack in the climate finance arena than there has ever been before. And I think we've seen that in the US government's own international climate finance strategy, which came out earlier this year, a tripling of our finance for adaptation, a doubling of our climate finance budgets, and a commitment to work together on things like Amazon deforestation. And notably, I should have added, we are now co-chairing with China the Sustainable Finance Working Group within the context of the G20. So we have a very, very open dialogue with China on all things related to sustainable finance and this question of how markets can move more quickly to expedite this transition.
That's interesting one. My friend Dr. Majun, who's on the Chinese side of that co-chairing, is of course also working in Inner Mongolia on coal transition, which our friends at Rocky Mountain Institute have been doing in Colorado. There's so much to share about doing this in a common agenda. And,
That's right.
In Europe, we're tackling this issue in Poland at the moment. And
absolutely.
And for our listeners now, I'm just going to say we're going to hear a little bit of talk tomorrow on our Transitions Day about a new steel project in the Asturias using green hydrogen, which is going to be involving the repurposing of coal plants to start using different feedstocks and keeping jobs of coal workers as transition, leapfrogging past gas to deep green. And so this is the stuff we've got to work on, isn't it?
Indeed.
I guess, John, this is reason for hope.
I think so.
The headlines are still bad, but
yeah. Look, it's hard to be in this field if you don't go in every day with hope. And I think what's different now, again, are two things. One is I would say economic tailwinds because of the kind of cost curve compression that we've seen on so many of the underlying technologies. Not enough yet, but so many of the underlying technologies, which now make solving climate change or addressing climate change an economic asset, essentially, as opposed to a liability to a country or to an investor. Number one. And number two, frankly, the stakeholder pressure from CSOs and from NGOs around the world for years, I think has paid off in many ways by creating pressure on institutional investors and sources of capital in very, very effective ways. And I guess finally, when you have 55% of global GDP that has committed to publicly a net zero target, and you're an institutional investor thinking about a 20-year investment horizon for a set of assets, or a private equity fund thinking about raising your next fund and having to exit that fund in 7 years, you have to think about the carbon intensity of that portfolio, because you know that the scrutiny and the attention around that sector that you're targeting is not going to be lower in 7 years than it is today. And if anything, it's going to be higher. You know that there's not going to be a less likelihood that there'll be some sort of carbon price on that, on those assets today. There's a greater likelihood. And so all those factors, I think, are combining to push us much more quickly than I think many people realize toward a posture where capital will be deployed, even absent harmonization and interoperability, where capital will be deployed more carefully and more conscientiously toward the transition.
Well, I can tell you that from the institutional investment community in Europe and in the US, there is an extraordinary amount of engagement on this issue, as we've seen some of the recent wins by the shareholder action people in the US too. So that shift is certainly happening. The money is keen to move. What they're looking for is the deals. And that's why the infrastructure bill is so important. And of course, that's why all the other measures you talk about are so important. Look, John, we're out of time. Thank you so much for joining me today, for joining our audience. As you said, the 3,000 people listening to our conversation. There's a lot to be done, but at least the world is moving. We know what the future is going to look like. It is still now a question of the speed of change. So on that line, good luck. We need you to succeed.
Thank you. Sean, thanks for the time. Really appreciate the opportunity to speak with you today, and thanks for the invitation.